I want you to think of a new way of measuring money. Whoever has the most purchasing power wins. All right? Let's say Marge has $1 million in her IRA. Using the traditional method of valuing money, total dollars, she has $1 million. Let's say Lev has $900,000, but it's money he already paid tax on. We would all agree that he has less money than Marge. He has $900,000, she has $1 million. But if they both wanted to go out and buy something, she would have to cash in her IRA, pay a couple $100,000 in taxes, and when she's done, she has less purchasing power than Lev. Would everybody agree that they would rather, if they had a short-term expense coming up, a big short-term expense, wouldn't you rather have $900,000 that you already pay tax on than $1 million that you haven't? So basically what you're saying is purchasing power is more important than total dollars, right? Can everybody go along with that? All right, so we're going to talk about purchasing power. All right, so let's say Marge has $100,000 in a traditional IRA, 401k, 403b, SEP, KEO, etc. All right? And let's say she has $25,000 outside the retirement plan. Would we all agree that she has $125,000? Right? Not a trick question. If she wanted to go out and buy something, and let's, for this simple example, assume that let's assume a flat income tax rate of 25%. She'd have to cash in her IRA, right? In this example, I conveniently have the money to pay the tax on cashing in the IRA from outside the IRA. All right? So now she uses this money to pay the tax on withdrawing the IRA. So now the IRS has it, leaving her $100,000 of purchasing power. So would you all agree in this situation, using a flat income tax assumption of 25%, that even though Marge has total $125,000, that she only has $100,000 in purchasing power? We all agree with that? All right. Now Lev says, hey, you know something? I want to do a Roth IRA conversion. So he or the advisor or somebody does the paperwork, and he converts his $100,000 IRA to a Roth IRA. Let's say the money's at Schwab or somewhere, and they'll send them a 1099. It says, please add $100,000 to your income. Now let's assume again, flat income tax rate of 25%. So he has to pay tax on the extra $100,000. So he has to give up the $25,000 that Marge doesn't have to give up unless she cashes in her IRA. So he doesn't have it anymore. So he only has $100,000, but it's $100,000 in a Roth. Okay? How much tax is there when you cash in a Roth? You're supposed to say none. None. So basically, Lev, measured in purchasing power, has the same purchasing power as Marge. Does everybody get that? That's critical. And see, so many of the financial advisors don't, and even so many of the writers don't. They say Roths are good for young people because they'll have enough time to make up for the taxes that they have to pay. But that's not only not good analysis, it's worse than nothing because people rely on it and they do nothing when they should be making Roth conversions. And to me, this is a really interesting reason to do a Roth conversion. Well, that's not fair. Right now, all I've done is shows it breaks even. Okay? I still haven't given you a good enough reason to do it because I'm not going to write a check to the IRS for $25,000 to break even. All right. Is there anybody here that is a little bit quantitative in background? An engineer or scientist that will admit it? There's a bunch of, I know some of you are, but all right, so nobody wants to admit it. That's okay. But to satisfy the quantitative folks, what I'd like to do is to do projections into the future where we take the $100,000 that Marge has in her IRA and we use certain assumptions for growth and we roll that forward. We have her invest the $25,000, but she has to pay tax every year on the interest, dividends, and capital gains. Then we subtract out the taxes that would have to be paid on the IRA to arrive at purchasing power. All right? Then we compare that to Lathe, who only has $100,000, but it's all tax-free. All right? And what I'm going to present is the results of that analysis. All right? Now, by the way, can I assume that everybody here trusts everything that you hear from a financial advisor or an attorney? No, absolutely not. Well, I knew I was going to have that problem because in 1997, when I realized how powerful the Roth conversions were, I knew that I wanted to tell people about it, and I knew that nobody was going to believe me. So I went to the AICPA's tax journal called The Tax Advisor. It's kind of like the equivalent of the New England Journal of Medicine for CPAs, and said, I want to write the lead article on Roth IRA conversions. And very frankly, I came to them in '97 before it was even law. And they gave it to me without even realizing what an important topic it was. And it won Article of the Year. And anyway, all the analysis I'm about to present is basically an update of that analysis. The only difference is tax rates are actually lower now, so the advantages of the Roth is actually less than it was back then. But if we compare Lathe, who does the conversion, all right, with Marge, who does not, and we run this forward for 20 years, we find that Lathe is better off by $50,000. All right? In the event that Lathe and Marge, let's even say that they do get married, they leave it to their spouse, and then when their spouse dies, it goes to the next generation, one generation younger than them. What would the impact of, let's say, Lathe's either children, nieces, nephews, whatever it might be, one generation lower? That, by the way, I'm going to skip all the assumptions because it's boring. Difference between Lathe's kids and Marge's kids are $600,000. And if you leave it to two generations younger, it's literally $8.9 million. All right? Now, to be fair, there is a flaw in the analysis. That's total dollars. If I include inflation and measure it in today's dollars, Lathe isn't really better off by $50,000, he's better off by $28,000. The next generation isn't better off by $608, they're better off by $160, and two generations down isn't better off by $8.9 million, they're better off by $838,000. But anyway, it's a very powerful strategy. Now, there are times when it, based on tax brackets, it sometimes makes sense to do conversions before getting married, and sometimes it makes sense to do Roth IRA conversions after getting married. In reality, we can't assume a flat income tax rate of 25%. And in reality, when you do a conversion, it's on top of your existing income, and it often raises your tax rate. So depending on your situation, if you're not getting married, if you're not married now and you're thinking of getting married, one of the things that you might consider is doing some Roth analysis, and maybe it makes sense to do the Roth conversion before you're married. Or we've actually, I mean, this might sound a little bit morbid, but we've actually, when somebody is terminally ill, we try to take advantage of the marital, particularly if they're not earning a lot of money, we try to take advantage of the lower marital rates, and we do the conversion before they die. We have done a number, it sounds a little morbid, but we have done deathbed Roth IRA conversions. And we've saved hundreds of thousands, if not millions of dollars for the next two generations. So there is some tie-in to Roth conversions and getting married. Typically, by the way, I don't tell people do $1 million Roth. I usually do smaller amounts over a number of years. By the way, I have a 2-hour workshop that actually is available to you just on Roth IRA conversions. I also do an 8-hour Roth IRA conversion workshop, which I will spare everybody here and probably anybody listening. That's for financial advisors only.